All right, we have a fantastic presentation here tonight, and what we're going to be talking about is shorting iron condors, which in very simple terms is shorting an out-of-the-money put spread under support, out-of-the-money call spread over resistance in range-bound markets. Now, your first reaction might be thinking, well, damn, what are you talking about range-bound markets? Since the March low, the market has been on fire over 40, 50%, whatever the stats are. And yes, they've had incredible runs, but a couple things. This is one strategy in our toolbox. We trade stocks, we trade options, we trade commodities, we trade currencies. Anything that the master trader method does applies to anything that moves on any time frame. We trade stocks and options. I personally have been trading options for 25 years because I find them just easier to trade. They're more three-dimensional. It's not like in your automobile that you have forward and reverse. That's all you can do when you buy or short stock. These are more three-dimensional. And then I split option trading into two broad categories. One is what's called directional. And what that means is I have a beautiful pattern, I have multiple time frames in alignment, and I want a big return on my call option with leverage and limited risk and less loss than if I did buy the underlying. Today, we're going to talk about what's called an income strategy. And that's by selling options around compelling patterns. And this is, we're actually selling two sets of options in range-bound markets. So again, back to my comment about, well, why would I do that in a stellar bull market? Well, I mentioned one of the reasons, which is it's just another tool that you pull out of your toolkit when the setup matches the chart. Number two is the following. Yes, the markets are on fire. We all know that there's very narrow breadth. You can research all the stats about in our green trading room today at Master Trader, our live trading room. Some of the subscribers are throwing out some stats like our FANG stocks are bigger than the whole European Union stock market, that Apple is bigger than the Russell 2000, etc. So that's a function of narrow breadth, that the limited monsters are getting bigger and bigger and bigger. And so what that means is there's many other stocks when you start drilling down that are candidates for this strategy that I'm going to share with you today. So let's keep going. I got a lot of great information here for you tonight. This is our approach. Some people might say their approach is a moving average crossover, is Ichikumi Cloud, which I'm probably butchering the name, is fundamental analysis. There's a lot of ways to skin the cat in the stock market. This is ours. Master Trader starts with a compelling price pattern on multiple time frames. What's the trend? Where's support and resistance? Is it showing relative strength or weakness? What's my retracement analysis? Are there green, red bars ignored? What are the market internals doing? And I know that all that sounds like a mouthful, but when you follow what we teach, you put all these components together and you genuinely, objectively know what to do with whatever you are looking at on any time frame, any instrument. You could be looking at the euro, the gold, Shopify, the Qs. You could be looking at a bag of rocks if you can chart them. And our method will show you how to trade that. We like to keep things simple, the keep it simple method. Stocks can only do these three things. Uptrend. What's an uptrend? It's not a move, it's not an oscillator, it's not a moving average, it's not some ridiculous proprietary tool. It's higher highs, higher lows. And then we have quality of trends, obviously. Downtrend, lower lows, lower highs. Sideways trends, relatively equal highs and lows. Okay, that's what we teach. how to recognize what trend you're in, and then we give you the toolbox of what tools you're going to use in these three trends. And we show you exactly the pictures of how to get on board the picture in each trend. We teach you how to calculate position size. We teach you where to put your protective stop, and we teach you how to manage in between. And my partner Greg calls it factory work, because once you have those tools, then all you're doing is factory work every single day. I have so many analogies. I say it's another bus coming by. It's another bus. It's another trade. I put it on and I manage in between. Today, we're going to be talking about this bus, things that are bouncing around in sideways trends. When we have an uptrend or sideways trend, we're going to sell a bull put credit spread. What does that mean? I'm going to sell a put option under support. I'm going to buy a further out of the money put option with the money I just put in my pocket. The difference of that is what's called a net credit. Money is coming into my account. Now, some idiots on the street will say that's instant income. It's totally not. It's premium that goes in your pocket, and you have an obligation to buy the underlying before expiration. We profit though if the stock goes up, if it goes sideways, and it can even go down a little bit, all the way, it can go all the way down to our break-even point, and we still make money. That's the beautiful thing of selling options using the charts. Bear call credit spread, we're going to sell them at resistance in downtrends. We're going to sell them at resistance in sideways trends. One of our 3 advisory letters is called the Weekly Options Trader, and it specializes in selling these options and spreads that expire 10 days or less. And so that cushion all the way to break even is what I call it's our edge. The stock can go against us and we still make money. That's a beautiful thing. I have hundreds and hundreds of examples. Like SHOP was one of them. SHOP, I noticed the other speaker mentioned SHOP. We sold a put spread on that. It went a couple bars against us, and we still made 90% of our maximum gain. I say it's like an insurance company. We get paid every day unless some unexpected gap really occurs against us. This is just to show you real quickly how when you buy options, it is a time depleting asset. You are buying an option for the right to buy or sell the underlying on or before expiration. And we do that. I have a whole directional course that I've just launched, and we have our full options course. So I love buying options. But again, today we're focused on selling them in sideways markets. And the benefit of selling options is the time decay, and our edge is putting them on with the chart bias. Now, there's some people out there in the industry who trade options who think, oh, nobody can read chart direction and it's a coin flip, and just look at the math, look at the Greeks, and that's the only thing you need to know. And folks, I don't have enough time to get into that today, but I propose to you that's 100% nonsense in a very short amount of time. If you are trading that mechanical method, I could eliminate 80% of your gains in probably 1 hour of education. Come visit us in the green trading room and at Master Trader, and I will show you how. But this is showing how the time value of short expiring options just falls off a cliff. So in today's lesson, we are going to be the beneficiary of that time decay. Here's my sideways range, trading range on whatever instrument it is. Over resistance, I'm going to sell a bear call credit spread. I'll show you many examples. I think I see a question here. Nick's asking, show me an example. Nick, I am all about examples. So just bear with me here a moment or two, and I'll overwhelm you. Going to sell an out of the money bear call credit spread. I'm going to sell an out of the money bull put credit spread under support. And I'm showing you this bird because that's where this name came from. The wings from this bird, the condors. Who came up with this name? I didn't. Our maximum profit when we sell options is the money we put in our brokerage account. So it's the net credit of this, the net credit of this. That's my potential gain. What's my max loss? Again, let me just move on and show you with examples, because then it's real numbers instead of just words. Same thing I just showed you, but with some pretty candlesticks with reversal patterns. And this is what we teach at Master Trader. We teach objective price analysis, and then we show you, based on your bias, of whether you want to trade stocks or options around them. So this little stick figure, wow, they're so, it's beautiful. This is what we call an M top with a bearish reversal at resistance. This is a W bottom with what we call a potent wide range bar reversal. Like, again, I don't care if this is the Qs or a bag of rocks. This is a salivating reversal right here that I would want to buy stock, I'd want to buy options, and I'd want to sell put spreads, like I'm going to show you as we continue. Here you had a little breakout failure at resistance. Here, a 180 reversal, so on and so forth. So this is what my partner's Greg's swing trading course teaches you, how to objectively read what the heck do these bars mean. I'm not showing you time frames. I'm not showing you what it is. It doesn't matter. We will teach you how to read the messages of this. Now, real examples. When I'm going to discuss with you today, putting on an iron condor as an opening trade. Opening means I'm selling both my call spread and my put spread as one opening order. And we have a very specific price pattern that I'm showing you here in the next couple slides of when we put that on. Some people just do it arbitrarily, the mechanical option traders, without any bias whatsoever of the underlying. And we think that is an ostrich approach. Putting your head in the hole, driving down the street with blindfolded, that's just ridiculous as trading methodology to us. So here we have a major pivot high, we have a major pivot low, which means it pivoted. I have higher highs to the left, higher highs to the right, another one, another one, another one, resistance, resistance, and I have a lot of space in between. So even if you were brand new to trading, and I just gave you a 20-minute course on what these mean, it should be fairly obvious to you if I were to ask you, hey, Mark, Nick, whatever, what do you think the odds of this busting through this red line or falling through this green line are in the next couple of days? I have a flat 20 period, flat 50 period moving average, flat 200. So by definition, moving averages, just take the prior days and divide them by the respective number. It's saying I'm in a sideways trend. I don't know if I'm going up or down. And that's when we want to sell these iron condors as an opening trade. Let's continue. I have a lot of examples here in a short amount of time. But once I show you one, the others go quick. So I have multiple spots of resistance, multiple spots of support, big range in between. I'm just mentioning implied volatility here because we love selling volatility when volatility is high. So let me now show you in one order, let me show you my two credit spreads. This one is a put spread. So here's my support. I'm going to sell a 260 put. I'm going to buy a $10 lower 250 put. Then I'm going to simultaneously sell this out of the money 330 call option, sell a 340 call. I have 22 days to expiration for this thing to bobble around in a $70 range. I take 90 cents a share in my pocket, and if my software is defaulted to a 10 lot. So if you sell 10 of these contracts, you multiply this times 1,000 because one contract represents 100 shares. $900 hits my account as soon as I get filled on this, less commissions, of course. That $900 is 100% profit as long as 22 days to expiration. This stock just bobbles around in here. Now, could you say that if you were buying the stock? That you're going to make $900 if it stays in a $70 range? If you walk up, I make this silly analogy. You walk into the Wynn Hotel up to one of their booths and say, "Hey, I want to put on this trade." They're going to be like, "Sir, you're in the wrong building. I don't have any idea what you're talking about. I'll sell you stock, I'll short you stock, but I'm not selling you this convoluted thing that you just presented to me." Well, that's the beauty of this trade in the option market. You make $900 on this trade if it bobbles around in a $70 range. And then we always have protective stops. And sometimes you get these haters on YouTube or wherever. They're like, "Oh, don't listen to him. That's the stupidest trade I've ever heard because you're risking $9.10 to make 90 cents a share." Mathematically, in a textbook, that's a correct statement. But I have two responses to that. Number one is we take our stop loss under support. We never hit our maximum loss. That's like saying, hey, you're buying the stock at $293 and you have a $5 target, but the stock can go to zero, so you're risking $293 to make $5. So did you see how ludicrous that sounds? This stock's not going to zero if I'm buying it as a swing trade. Well, same thing in this. I'm coming nowhere near my maximum loss. I just want it to bobble around, but we have our protective stops if it does decide to violate our bias in that time frame. All right, a couple more examples so I can speed up here. So same thing, PayPal here is bobbling around in this trading range. You can see the MAs flat, so this is perfect. I have high implied volatility. I'm going to sell an out of the money put spread. I'm going to sell a $75 put, buy a $5 low or 70. Look at resistance, way the heck up here at 90. I'm going to sell a 90 call, buy a 95. I get $1.05 a share. Look, I mean, this says $1.13. You know, I say $1.05 for slippage or whatever. And then you take your maximum loss, which is the textbook loss. You divide my premium, which is my maximum gain, by my maximum loss. 26% return on capital, folks. And all this stock has to do is bobble around in this range for 19 days. And if you do a 10 lot, you've booked another $1,000, $1,050. So it's another tool. If you took our course and we were scanning for compelling setups, and I was looking for a directional trade, which is, hey, that's a beautiful long, beautiful short. There's nothing to do here. I would just keep scrolling to the next one. But with the beauty of this trade, another tool in your toolkit, you're putting over $1,000 in your pocket on a trade that, if you were just trading stock, would not exist. And that's the beautiful thing of what I'm sharing with you today. This one we gave to our subscribers. So we have the weekly options trader, where I mentioned to you, we sell options that expire 10 days or less. And this actually was an originating trade. We said, yeah, let's go ahead and sell an out of the money call spread, out of the money put spread. I got all these flat MAs. We're betting that it bobbles around. And we took in on this one, you know, 42 cents a share for only $2 wide. You can do the return on capital calculation on your own. And it was a great trade. Uber here, same. I have specific reference points of resistance, specific reference points of support. Again, you're going to notice on all these examples, I wouldn't buy them. These are new trade opportunities that do not exist if you're just trading the underlying. I see a question for the 4 trades. Yes, we put them on as one opening trade. In a moment, I'm going to show you how we use it as an adjustment strategy. But right now, look, I'm showing you right here. It says right here, Iron Condor. This is TOS, is what I'm currently using. So you put all this in, the midpoint's 54 cents a share, divided by my maximum loss, 22%, as long as it bobbles around in here for 10 days. I give you the textbook answer again, because I don't want anybody telling me, oh, he's just showing you the upside, not the downside. That's an incorrect statement. The max loss is $2.46 a share, but we will never incur that if you put a stop under support and a stop over resistance. You'll never get anywhere near 246. In fact, our average loss doesn't exceed 1 R of the credit received. And what that means is you sell it for 54 cents. Even if we stop out, the stop out shouldn't exceed 54 cents. So if you do the math, like if you're in Vegas, if we have an 85%, I know I'm talking fast because we have limited time and I have so much great information here for you. So just take notes or get the recording on this and you can listen to it again later. But listen, folks, if you have a 1-to-1 reward to risk and you have an 85% batting average, that is a beautiful uptrend. Now, yes, you're gonna have some losses that may be a gap against you. It could be a volatile stock that your loss is greater than 1-to-1. But that's why, similar to an insurance company or a casino, they're taking in money all the time, and they're very prudent risk managers of managing the downside, which is having to pay out the claims, and that's exactly what we teach. Another example here, I don't even need to cover it. You sell an out of the money call spread, out of the money put spread, and here are the numbers right there. That one was 30% return on capital. Here, WB, all this resistance, all this support. We're going to sell the out of the money $70 call, buy the $75 call. That's a bear call credit spread. I got my bull put credit spread down here, and wow, this was big credit. We're taking in $1.32 a share. You divide that by your $5 Y max loss, and that's huge return on capital. All right, so let me show you the break evens now. So think about this. If you, on this trade, we're taking in $1.32 a share, even though I'm saying here to my subscribers, let's do it for $1.15 a share. So let's just go with the 115. The stock at expiration can go to my short strike plus the premium received of 115. So it can go all the way to $71.15. And I break even on this trade. Can you say that by buying stock at $58 and change? That's if it goes against you to the upside. If it goes against you to the downside, well, I'm obligated to buy the stock at the lower strike put, the $53, and you subtract $1.15 from 53, so it can go $1.15 below my short strike, and I'm break even. So I hope you all are getting really excited if this is a new strategy to you, for you to say, wow, I can't believe that this is really true. I'm showing you real trades that we give to our subscribers with the real math and the real management. OIH, this is just an oil ETF, it's been a dog. So, this is one we've been doing credit spreads. And I'm just saying, look, these are other examples of a mess. Look, I type it here, a range-bound mess. Now, where else can you make money in the stock market where you say, oh, look at this mess, and I can make money on it? Well, you can with selling options. So I've just showed you how to put on an opening trade. Now let me show you how we use this as an adjustment strategy if we start the trade with only one side. And we typically start over 95% of the time, we start with one side. And you say, well, why is that, Dan? Well, this is a very easy answer. Because our chart analysis, we have more of a bullish or bearish bias. All the charts I just showed you, I had a neutral bias. I don't know where this mess is going. I think it's going to bobble around between support and resistance. So now I'm showing you how we use this to adjust our bias. So as long as the underlying trade is fine, but you say, you know what, it kind of moved more than I liked, then that's when let me just go right to the pictures. That's when we're going to leg into one of these iron condors. Now, in my full options course, I get into a lot more details of repair strategies, rolling strategies, etc. But here's a real example that we were in. So Seagate. This rallied to resistance, had a bearish retracement, and so we started off with one side of the trade. We sold an out of the money bear call credit spread. So we're in the trade, it broke down, we're having a good time, we have a nice open profit. We could have just tightened our stop to break even and been done with the trade at a profit. Nothing wrong with that. So full profit if it closes below my $60 short strike, and break even, as I just showed you on the other slide, you take your premium, add it to the short strike, so my break even is $60.80. 19% if expires worthless. All right, that's slide one. Let's continue. Uh-oh. What do I, well, look at this guy. What do I do now? What do I do now? My original stop was over here, so it hadn't stopped out, but my bias has changed. So what I'm going to do now is sell an out of the money put spread. 52.5, way the heck down here, way the heck down here. And all this mess here, Greg will teach you in the swing trading course, how this was what we call a downside shakeout, red bars ignored. So we are very comfortable with selling an out of the money put spread. And what this does is it raises now our total credit. You know, there are the break evens, that's slide 2. Let's take a look at slide 3. I'm in management mode. I'm in management mode. So these are my new line. Well, that's my existing line in the sand, and here's my line in the sand. So it reversed a resistance. So I can breathe. Everything's fine. And remember the slide when you sell options that we're making money through time decay. So every day that goes by, and like I said, what I called an unexpected disaster, like if it were to get bought out at 70 bucks, or the CEO admitted to accounting fraud and it gapped down to 50 bucks, you know, other than something crazy like that, we're making money day by day through time decay. And we've increased our net credit. So question, is this now an even better candidate for an iron condor like we talked about earlier from the outset? Would you put on a new trade here and a new trade now? I bring this green bar up even under this bar. And the answer is sure. Yeah, that's a beautiful condor example. This was just another example. I'm not going to go through it. So that's if we put on the bear call credit spread right here, and these were real trades, and that's why they're good educational. And then it broke out. But look, we sold a put spread here. Now watch, folks. Here, this is magical, magical. We legged into our condor right where this arrow is. We legged into a condor because even though this is a mess, we teach bar by bar analysis and what each of these bars means. And right here on this arrow, we're like, uh-oh, this is now turning more bullish than bearish. Follow the math. We took in another 70 cents a share. We stopped out of the call spread because that was our stop over this 2-bar reversal. Look at this, folks. We stopped out of the call spread for a 50 cent a share loss. So that was my 1-to-1. We sold it for 50, we lost 50. But guess what? We made 70 on the put spread. So by legging into this condor, we netted, I know it's not a big number, but through our strategy on a 10 lot, we salvaged it and still made 200 bucks with the stock going against us. That's a great feeling. All right, let me finish with a short checklist here, and then we will wrap it up. I always like being on time. Here's your short iron condor checklist. Create a universe of liquid stocks. scan your universe, and Greg and I, we use TC2000. Here's a picture. This is where we find these trades. These are basing scans that Greg created, and then we just go through one by one, and we see if they look like the picture that I just showed you in the first 10, 15 slides. If they are, I continue to go through my checklist. We're going to sell a condor above resistance, below support. I want at least 20% of the spread width. What does that mean? Well, if I have a $5 wide on both sides, then I want $1. Give me $1. I'm not interested. Then our courses teach you how to pick the strike, expiration, but we do them under 30 days because of the time decay. Make sure they are liquid. This is the biggest problem in option trading, is they aren't liquid. Make sure there's no pending news, no earnings, none of that stuff. Then follow your trading plan once you're in it, with the stops, taking partial profits, etc. Folks, I hope you enjoyed that. I mentioned to you, we have, this is just another marvelous tool. We teach credit spreads, and that's what I wanted to show you here. If you go to mastertrader.com/spread trader, we have an advanced credit spread course, a mastering course, which covers the same subject, but in much greater detail, 12 very detailed modules. Now, these courses focus on selling the credit spreads, but the advanced one focuses on it includes the condors, adjustment strategies, things that we've been talking about today. And for a no-brainer, extra little premium here, we give you 3 months of our green trading room, which is our live trading room. Come watch us trade, watch us talk, watch the walk every single market day. And then the weekly options trader, which I mentioned is selling these options that expire 10 days or less. It's 6 o'clock. I appreciate everybody attending. I hope you learned a lot. Feel free to email me, Dan@mastertrader.com. Come check us out. We'd love to help you achieve your trading and financial goals. Have a great night, everyone.